The next time we have a bear market, and I don't know when it's coming, at Thoughtful Money they know, but I know we're going to have more bear markets, and I know that the next one is going to be the worst in my lifetime.
In times of economic uncertainty, how can investors navigate the markets with confidence? And the answer lies in the wisdom of legendary investor Jim Rogers. In this video, I'll break down Rogers' contrarian approach to investing and reveal the key principles that have fueled his success through countless market cycles. He shorted Fannie Mae back in 2008. Nobody thought that anything bad was going to happen to this rock solid stock. Well, it wasn't very rock solid at all. He made an absolute fortune out of it. On the back of that, Rogers retired at 37 years old, but has remained an active investor for himself and trader.
What I have said, and I will say again, the next time we have a bear market, and I don't know when it's coming, at Thoughtful Money they know, but I know we're going to have more bear markets, and I know that the next one is going to be the worst in my lifetime. Adam, 2008 was a problem because of too much debt. Look out the window. Since 2008, the debt has skyrocketed everywhere. Even China has a lot of debt now. So all I'm saying is, and I don't know when it's coming, that the next time it's going to be a nasty, horrible, disastrous bear market.
Who is Jim Rogers? Like I said, a real legendary investor. He's actually the co-founder of the famous quantum fund with no other than George Soros. That's right, the legendary trader George Soros, who broke the Bank of England, who made $1 billion in just one day. Listen to this, between 1973 and 1983, these duo, the two of them, managed a return of over 4,000%, while at the same time the S&P 500 managed 42. On the back of that, Rogers retired at 37 years old, but has remained an active investor for himself and trader. So what are his core investment philosophies and principles? Let's go through some of them. For example, independent thinking.
I have found that when I get ideas from other people, I nearly always make a mistake. So I have learned, I try to discipline myself that if I hear something from you or anybody, that I try to ignore it and not act on it, because most of the time when I follow someone else's suggestions, I have lost money.
So he's big into avoiding this kind of herd mentality and popular opinion, definitely not listening to Wall Street analysts. So for example, he got into China back in the 90s. Nobody was interested in China back then. The second thing is, be a contrarian investor. He shorted Fannie Mae back in 2008. Nobody thought that anything bad was going to happen to this rock solid stock. Well, it wasn't very rock solid at all. He made an absolute fortune out of it. And, part of that is really conducting exhaustive research on companies and sectors. For example, he actually traveled the world by motorcycle, and he did multi-year visits. I'll talk about his China one in a moment. But to really get down and dirty and understand what's really going on. So not research as in reading about things, but actually doing it. The third one really is he has huge patience. Most people don't nowadays. He has absolute patience. He takes a long-term approach. So for example, his Chinese investments, which he started in 1999, he's still holding a lot of them. So we're talking about multi-decades of holding on and hanging tight. Because why? Because he knows that markets are cyclical. He knows that, right? And if you know that, you won't panic. And he'll really wait very, very patiently. So for example, he went into the commodities market in the 1990s when everybody else was like, no way should you get into that. So he's a bit of a contrarian investor as well.
The only asset class that's still cheap that I know of is commodities. I mean, silver's down 60% from its all-time high. Sugar, oh my gosh, sugar's a disaster. So most commodities, many commodities are still cheap on a historic basis, and I do not know other asset classes where that is the case.
And there's this whole thing, which I find really interesting with him, is about timing the market, right, versus time in the market. And he's definitely a time in the market kind of guy. What's really interesting about him is because he doesn't make this distinction that most people do, which I do as well, actually. He doesn't, which is about the difference between trading and investing. He just says, why do people keep going on about that? I go into something, and he admits way too early normally, right? But if it were to go up 1,000% in one day, he wouldn't go, well, I'm an investor, so I'm going to stay in for 2 years. If it goes up, he will start eventually coming out of it and selling it, right? And if it takes longer, that's fine as well. So he doesn't make that distinction. He just gets in, whatever you call it, investing, trading, he gets in, and eventually he will be right. Even though he says, I'm normally 6 months to 18 months too early. He says, I'm a terrible market timer. By the way, this is somebody who is worth hundreds of millions and has made billions for other people as well. The fourth thing that really comes up when studying Jim Rogers is concentration. I don't mean concentration here, but making concentrated bets when you have conviction. He is totally against the idea of diversifying, which is really interesting, isn't it? Because everybody talks about how important it is to diversify and not put all your eggs into one basket. Well, guess what? Jim Rogers is the exact opposite. He says, instead of doing that, put it into a basket and watch that basket like a hawk. It's really interesting, right? Number 5 is preserving capital. He's big into never losing money, which again reminds me of Warren Buffett. Remember, rule number 1 is never lose money. Rule number 2, refer to rule number 1. But for Jim, it's slightly different. He knows that there are market cycles, so he avoids impulsive selling during market downturns that everybody does when they panic, by knowing through his experience that there are these market cycles and things will come back eventually. He doesn't know when, but they will, right? The next one is opportunistic. He says you need to look for neglected or undervalued assets and areas. So whatever is out of favor, he will invest in, which kind of makes sense if you think about it, because that means it's down. And most people are like, oh, this is going up, and they jump in, right? He does the exact opposite. He's a contrarian investor. I love contrarian investors because it just makes sense. Because when something is out of favor, generally speaking, the price is down. Coupled with that, he says invest where you see long-term trends developing. So for him, I mean, this is so incredible. He saw in the 2000s that Asia was going to be overtaking the West. Right? The West was kind of coming down, and it's all to do with growth in Asia. So guess what he did? In 2007, he just uprooted his entire family and decided to live in Asia. Most people wouldn't do that. Most people wouldn't have thought about that. But even the people that know this, that know that the future's in Asia, they wouldn't uproot their family because of school, because of, friends. He just uprooted his entire family and now lives in Singapore. Also, Jim is really open-minded about opportunities across sectors, asset classes, and geographies. Well, we know this because he invested in China, he invested in Austria, right? What do most people do? They're just stocks in your own country. I mean, I live in the UK, but it doesn't mean I invest in the UK. Why? Because it just doesn't move. I invest in the US. But there's a lot more than the US, and there are so many opportunities out there if you just look around. Why? Because when one part of the world, let's say the US for example, is booming, there's going to be another part of the world which is down. Well, which one do you invest in? Well, actually, they're down if you're a contrarian investor, right? And vice versa. But most people are just like this. It's fascinating. There's a whole world out there. So let's have a look at the methodology that he uses for evaluating his investments. Well, the first thing, in no particular order, is this kind of top-down economic approach to identify major long-term trends. Also, long-term thinking, avoiding the short-term market timing thing, which is so difficult. Everybody talks about it, but it is really, really challenging. Roger, what did he do? Gets into China, has massive patience, waits decades. He's still in after 25 years. Let's have a look at some examples of his success really early on. Some early investments in commodities, for example, in the late 90s. He's such a dude. He launched an international commodity index in 1993, and he really capitalized on commodities boom as a result, right? So he has real foresight in identifying long-term trends. And then, of course, the Chinese investments. In his late 90s up until present, he was in early, he stayed in, but now probably trying to get out now. But he did really, really well. And again, showing his openness to investing in various geographies and his long-term approach. Okay, let's have a look at his criteria for taking profits, i.e. when does he sell? Well, one thing we know, he is very, very patient. He's not in and out. He's not a trader like George Soros. He is into long-term holding, like periods from definitely years to even decades, absolute decades. Like Chinese, he's in for 20 plus years. And patience is definitely a hallmark of Jim Rogers investing, something that most people don't have. What's really interesting is that he establishes targets, so he knows in advance where he thinks he's going to get out. Now, most people don't do that. They get in and then they go, right, let's see what happens. Also, and I find this really fascinating, he waits for clear trend reversal signals based on market behaviors. So, for example, he might look for some catalytic factors that can change market directions before selling. I'll give you a couple of examples. For example, policy changes, right? So if the government, for example, the politicians, they start giving subsidies in certain kind of industries, he goes, well, if the government is going to put billions into that sector, I'm going to get into that sector. It kind of makes sense, right? And everybody knows when it's happening. The question is, do we respond? Jim Rogers does. And the other thing is sentiment and psychology, because Rogers knows that it's all about market sentiment and investor psychology. And he recognizes when it's changing. You know, emotional extremes can drive traditional market movements. And he just waits for that shift in market sentiment. So what are the key investing lessons from Jim Rogers? Okay, things like contrarian mindset and independent thinking. We already saw this in China. His focus of fundamentals and in-depth research. You know, he'll actually go into countries or he'll study Austrian economics, for example. Capitalizing on global trends, for example. He saw what happened in Singapore or what's happening in Asia, uprooted his family to live there, believing in the rise of Asia. Wow. Not diversifying too much and concentrated bets based on conviction and knowledge. Amazing. Next, patience and long-term perspective. Some of his investments are over 25 years, for example. And I have to tell you, I love this quote. He says, I just wait until there is money lying in the corner. And all I have to do is to go over there and pick it up. I do nothing in the meantime. I love that quote. What does that mean? That means he just waits for something to be really out of favor, does his research, and gets in and then just waits. The market does the work. Amazing. And lastly, continuous learning and humility. And if you see any of his interviews that he does, it's all about humility. He doesn't even think that he's anything special. He says, and he encourages investors to study hard and acknowledge the vastness of what they don't know. How can you apply Rogers' proven investment principles in your own portfolio? What are the key learnings? So, for example, the contrarian investing that he does into out-of-favor sectors, thorough research, for example, economic cycles, patience, waiting a long time. What else? Identifying emerging market opportunities, concentrated bets. There's so much, right? Continuous learning, staying open to new opportunities and ideas. Geographically, not staying there in one sector, but going all over the world and also different asset classes. What's the most important investing lesson that you've learned from Jim Rogers? Comment below.